Yes, sir. Hello, everyone. Welcome to Lupin Q1 Earnings Call. All participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the opening remarks. Should you need assistance during the conference call, please raise your hand from the Participants tab on your screen. Please note that this conference is being recorded. I now hand the conference over to the Lupin management. Thank you, and over to you, sir.
Hello. Can I take it up now?
Yes, sir.
Yes.
Hello. Good evening, friends. This is Kamal Sharma. I welcome you all to this earnings call. Just to open the call this evening, I would say that the present quarter has been kind of a mixed quarter for us. On one hand, we were very happy to receive research income of $50 million. On the other, we have had a few unanticipated events on the operating side, and that's why I felt that this has been a bit of a mixed quarter. But for the coming quarters, the prospects of business remain promising, especially going by the ramp up that we are seeing currently in complex generics, and the growth of the India business, which has been very promising for us. With that, we do feel that in the coming quarters, we would have a lot more, promising performance to discuss with all of you. To give you the details of various parameters, I will hand it over to our CFO, Mr. Swaminathan. Thank you.
Thank you, Dr. Sharma, and good evening, friends. Friends, I trust that you and your families are all keeping safe. In a quarter that was impacted by pressures in the US, we are pleased to deliver 22.2% growth year-on-year and 12.7% growth quarter-on-quarter, bolstered by $50 million milestone received from BI in this quarter. Business without the milestone income grew by 11.4% year-on-year and 2.8% quarter-on-quarter. Quarter-on-quarter growth was driven by our India business that grew 27.2% and growth markets that recorded 9.7% growth. The Indian market grew 39.2%, including COVID therapies, and 32.4% excluding these. The acute market grew 52.5%, and we grew 45.4%. The chronic market grew 19.4%, and we grew 22.6%. HCP attendance is back to 90% levels, and patient footfall is 77%. Our call average is 9.6. We see high teens growth in India for the year overall. US revenues were down sequentially due to competitive pressures on base business products, famotidine in particular, because there was new competition which had entered. Albuterol, of course, there was facing transition from spot buying to long-term contracts, and there's of course this element of failure to supply due to supply chain issues that cropped up last year, and that we have settled with our customers currently. Albuterol is ramping up nicely, and based on our commitments, it is on track to get 18 to 20% market share with a major pickup in Q3. Brovana AG has been a successful launch in the quarter, and we expect to contribute to growth in the current year. We remain committed to grow our US business, both with our inline products as well as ramp up of Albuterol and Brovana to continue above market growth in India, and of course, ensure growth in every part of the business. And of course, we feel extremely good about our NC efforts, and we're exploring ways to better fund the path forward, including a potential spin out. When I come to margins, gross margin as a percentage is down to 63.9% due to change in reporting of partnered products in the US. Royalties on partnered products were reflected in SG&A manufacturing and other expense line, and is now reflected in the gross margins line itself. On a net basis, partner products are EBITDA accretive. Gross margins was also impacted by change in sales mix insofar as India vis-a-vis America is concerned, and the US margins being lower, again driven by increased competition and slower ramp-up of albuterol. Whilst the quarter's profits were bolstered by Boehringer Ingelheim MEK program income, despite a tough operating environment, we see substantial room for growth. Employee cost was up vis-a-vis Q4, primarily due to increments in India and higher sales incentives for IRF, given the significant higher sales in this quarter. Q4 last year was also significantly lower, given certain incentive reversals in India. Amongst our peer set, we're the only ones that were able to bring down the manpower cost down as an absolute number in FY21. We intend to maintain tight control on this line while ensuring growth for the future. Manufacturing and other expenses were down 8% quarter on quarter, and this is partly because of the reclassification of partnered products royalty, as I spoke before, into COGM, as well as the lowering of expenses across various lines, say for promotion expenses, which went up because of increased business, especially in India. R&D expenses were 9.7% of sales, and we expect to hold this number tightly without losing out on opportunities. EBITDA without NCE income and forex loss stood at 14.3%, a level that we are not happy with at all after the EBITDA improvement that we had delivered through the quarters last year. We see meaningful uplift in the second half and remain focused on a journey of expanding margins through driving strong double-digit revenue growth and optimizing on costs while ensuring the safety of our people and the highest standards of compliance. Whilst we see our business in particular in the US improve quarter after quarter based on albuterol and Brovana ramp-up and stabilizing base business, we embarked on accelerating additional optimization efforts across our manufacturing and supply chain, including tackling idle costs for product categories where the demand has dropped. We're looking at finding solutions for areas like specialty, biosimilars, and NCE, including spinouts. Whilst we are not happy with our performance, we remain committed to improve our business throughout this fiscal. We expect revenues to grow about double digits, both in India and other parts, including America, and EBITDA to be 17 to 18% in the second half, which is lower than our earlier guidance of 19 to 20%. We see meaningful bounce back in the second half, driven by increased sales in albuterol, higher base in India, and growth across various markets. With this, may I open the floor for discussions?
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may raise your hand from the Participants tab on your screen. Participants are requested to use headphone or earphone while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We request you to please introduce yourself before asking the questions. First question is from Mr. Kunal Dhamesha.
Thank you for taking my question. So first question on the EBITDA margin guidance that we have given. So I think I probably misheard it. It's 17 to 18% in the second half, or it's for overall FY22?
We believe that the second quarter would also be a tough quarter for us. So we expect, in fact, the EBITDA margins to kind of ramp up in the second half. So we are saying about 17 to 18% is what we'll be reaching in the second half of the year.
So overall, then FY22 would be somewhere around 16, 17%. And that would exclude the 50 million income, right?
Yes, that is correct.
Sure. Thanks for that clarification. And in terms of the albuterol, when we say that we continue to hold our target for 18 to 20% market share, is it the market share of the entire albuterol market, or it's part of the generic albuterol market?
It's a share of the entire albuterol market.
And where would we be currently?
We are right now roughly, based on the weeklies, between 12 to 13%.
12 to 13%. Okay. Sure. And when you say that there was some settlement related to the failure to supply, so where that settlement has been recorded, in which line item in P&L?
It's been netted off from the sales itself.
So you would have supplied some quantity for which you would not have received some money, something like that?
It's something like actually saying that there will be a penalty paid for or inability to kind of supply in the past. So to that extent, it's netted off.
Sure. Yeah. And lastly, if I can squeeze in terms of specialty in the US, the solo sec, what would be our current investment from P&L after the rationalization of the cost?
Yeah, roughly $20 million in terms of EBITDA burn.
Sure. Okay. Thank you.
Thank you. Next question is from Mr. Prakash Agarwal.
Hello, am I audible?
Yeah.
Yeah, hi, good evening. Couple of questions. So one is what I hear or what I understand the signal right is albuterol scale up from 3Q. So I understand in Q4 you have mentioned that what the understanding was that you have got some stocking done and all, and there is some normalization in Q1. But why signaling 3Q and not Q2?
So Prakash, we actually moved strategically from one-time buys because of a limited, supply through Q4 into more longer-term contracts, and it's just the phasing of those contracts. Customers already had stock, and they're phasing in our products. So it's already started based on that 18 to 20% contracted business, but it's just a build-up.
Okay, and would the pricing be any different versus a short-term versus long-term contracts?
Yeah, the long-term contracts are, higher volume, a little bit lower pricing, but still very profitable, very high margin.
Okay, understand that. And you think this opportunity remains, 4-player, 5-player kind of market, and you don't expect anything in the near to medium term, like, calendar 23, 22 is where we see more competition coming up. Is that a possibility?
Yeah, we're not seeing any additional competition coming up. We haven't heard anything new from Perrigo on their ability to get back in, of course, tracking it very closely. So nothing in the next 12 to 18 months that we can see.
Got it. And secondly, on US FDA issues around, we are hearing some companies seeing audits. Are we somewhere near to that? And is our CAPA plan fully done for the 3 plants, now 4? If you could update there, please.
I can take that. Prakash, as you know, we've told FDA that we're ready for our Goa, Pithampur Unit 2 and our Tarapur sites. The status really remains the same. We don't have visibility at this point of time. We're aware that a few audits have started now. We believe they're mostly being conducted by the FDA India office. We've had remote interactions more for regular surveillance kind of inputs, but right now no particular traction on these 3 sites. Obviously, our goal is to remain in a state of readiness for imminent inspection at any point of time in these 3 sites.
Okay, and a quick one, if I may, on Brovana, why AG? We had a filing, so what's the background here?
Yeah, we were able to really get the authorized generic that allowed us to get into the market much earlier and before any of the other competitors. It's proven to be a very, very successful launch.
No, but I mean, I understand gross margins and EBITDA margins are, in the range of 15 to 20% for AG, whereas, we could have a long tail. So the cash flows you are saying is much superior in AG versus, what's the logic here?
Both cash flow as well as margins. Margins are EBITDA accretive with IAG.
Okay. Okay, thank you guys. All the best.
Thank you.
Thank you. Next question is from Sayan Mukherjee.
Yeah, hey, am I audible?
Yes.
Yeah. So on the US, the decline that you have seen quarter on quarter, you mentioned 3-4 reasons for that. Can you just help us understand like how much each one of them contributed to this, a sequential fall of $20-25 million that we have seen?
Yeah. So please go ahead.
Yeah,
Vinit.
go ahead. Umesh, please go ahead.
Yeah. So I would say that there were 5 reasons why gross margins fell a bit. First is, of course, famotidine. So obviously, that there are 2 more competitors in there. So obviously, we lost market share, and of course, the prices came down as well. We spoke about albuterol. We're getting into long-term contracts, moving away from spot purchases, and that's the reason why there has been a slow ramp up. The third is, as a result, in fact, there's of course the royalty accounting. So we moved it away from manufacturing other expenses into the COGM line itself, and to that extent, we actually have a lower gross margin for that, and that's about 1.3%, you could say. And there is of course this component of FTS, the failure to supply bit, and that being there actually brought down the salience of America in the overall scheme of things. So that means the margins which would be higher, which generally you could attribute to America, is lower. So that meant that the India business salience went up. So this is the mix actually contributed to the overall margins being lower.
Ramesh, I was just looking at this fall that has happened. How do you quantify this? I mean, out of this $20 million is like $10 million famotidine or albuterol. I just wanted to get a sense the major components of this quarter, this fall in US revenues.
The margin,
not the margin, the revenue number itself, like from sequentially the drop.
So we're not going to quantify by product, but I would say top down, it is albuterol, FTS, famotidine, and a couple of other baseline products also like metformin and levothyroxine that saw pricing pressure because of additional competition.
Okay.
That is top down.
Okay. And Vinita, just, this on pricing pressure. So we are kind of hearing, multiple things from multiple companies. What is your take on this? Why are we seeing this, sudden increase in sort of, it feels like there is a, spurt in pricing pressure. I mean, we are at a time when, you see a lot of inflationary pressures in general, freight costs are high. So what is the economics working out in your base business? And, what is your take on what's happening in the marketplace as far as, general pricing environment is concerned?
So Safan, the pricing environment has been tough, especially in the last couple of months. One major event was Econdisc broke out of the VBAT consortium to independently run their GPO and open the whole portfolio to a bid. So that really got companies aggressive from a pricing standpoint. Second, because of the FDA slowdown of inspections and therefore approvals, we've seen more competition on existing products than approval of new products, And third, I'd say, some of the new wave, companies that have gotten in, whether it's Alchem, Alembic, others, they have gotten more aggressive in trying to get share at pretty low pricing. So it's a combination of a couple of different things. And overall, just given the challenges that also our customers had this past year because of COVID, they've been trying to really make up for it in terms of the losses that they had, the margin loss they had by, trying to really gain on the generic front. So that is, the pricing dynamic. But overall, as we look at our product mix, when we look at the last couple of quarters before this Q1, mainly, with the ramp up of new products that offset older products, one feels pretty good about the ability to continue to increase both revenues and margins. Okay. Challenge this quarter has been a few unanticipated events. And also, I would say that from our perspective, a transition on albuterol that has taken a little bit longer, albeit, fairly confident of the ramp up.
Okay. Just Vinita, I mean, if you exclude famotidine and the dynamics around albuterol, the other base business, what has been a year-on-year price erosion or quarter-on-quarter price erosion approximately?
Like 4-5%.
That's year-on-year?
That's right.
Okay. And just one last question from my side before I join back. In the opening remarks, there was a mention about, possibility of spinning off of NC research, biosimilars and specialty. I just wanted to, get a sense of what you're thinking here. And, Vinita mentioned around 20 million annual impact on EBITDA from specialty. Can you quantify for biosimilars and NC research as to how much of a drag is that on your EBITDA?
So each of them are roughly around $20-25 million, totaling around $65 million, with the NCE being at 25 to 30, depending on how we progress our pipeline. So, 20 million each in specialty as well as on the biosimilars front.
Okay. And anything on your timelines and what you're exactly thinking? Are you trying to raise capital here separately? And anything you can share on your plans here?
Sure. So on the oncology front in particular, we have created Lupin Oncology in the US with the idea of really, bringing in third-party investors, mitigating, our spend, our burn. And, over the next 12 to 18 months, looking to find ways and means of raising additional capital as we progress our pipeline. We have two programs, lead programs that are going through IND enabling studies there. So the thought was as we file INDs in the next 12 months, that would be the right time for us to do a major capital raise around the oncology assets. So that is on, the oncology front.
Okay. And anything on biosimilars?
Hi, we request you to get back in the queue as well because
Sure.
we have other questions. Yeah. Thank you so much. The next question is from Mr. Anubhav Agarwal.
Yeah, hi. One question, Vinita, is on famotidine to start with. Now, whatever was the, let's say, earlier level for us, after two-player entering and price erosion happening, how material this will be product for us? Would you say this will be less than 5% or just around 5%? I'm not asking for number, but just trying to get a sense because we don't want to see another quarter where sales are down massively and everybody gets surprised.
Yeah, so I wouldn't say, I don't want to quantify the number that is really sharing, competitive information, but it is a material product for us, Anubhav. Not as big as it was, We certainly did not expect two competitors. We were expecting one competitor to come in, but I was surprised with the second. But have retained, 60-65% share on a very profitable basis. So it continues to be a material product for us.
Sure. And now, if you look at our quarterly sales, famotidine really started ramping up for around 4Q20, 1Q21 quarter for us. So if I subtract from 172 albuterol, let's say just assume some number for albuterol, subtract that, effectively, and if I were to take off famotidine as well, our base business has been completely, significantly impacted more than 4-5% that you mentioned about, because 172, let's say give and take, you minus 15 for albuterol, you minus another 10 for famotidine, then our base business should have declined significantly more, right? Let's say a year back or let's say 4Q20 level. Of course, there's no growth, but I see a decline, massive decline there.
That's right. We did see a base business decline over the last year, especially related to our supply challenges.
And when you see this, let's say 172 number, I'm just, which quarter, for example, I'm just trying to get a rough sense. When do you see this business hitting about $200 million mark? Would it be like the second half next year, or do you expect earlier than that?
We're hoping Q3 onwards.
No, Q3 of this year, or when you have Suprep launch next year, that's the Q3 you're talking?
No, we're thinking Q3 of this year.
And that will be largely driven by albuterol ramp up, or is there any other product? You have mentioned performance in the past, but is there any other big launch that you expect?
It's largely due to albuterol ramp up, Brovana contribution, as well as increase in inline product share that we have taken back again. So it's a combination of inline products plus albuterol as well as Brovana. In terms of material product launches, for the rest of the year, Sevelamer is one that we are planning to launch that looks promising to us. And we have a couple of other launches that are smaller. Major contribution is still albuterol, Brovana, and our inline products.
And thank you. Just one last clarification. In this quarter, average market share of albuterol, which would have been reflected in number, what would you say? Because IQVIA now shows you around 13% plus. So what would have been a number which would have been reflected in this quarter? I'm just asking percentage market share number which would have been reflected.
Yeah, so the percentage market share, like you said, the IQVIA numbers, the 13% is where we are at in terms of the prescription pickup. But when we look at the contracted share with our customer base, the long-term contracts, it's in the 18 to 20% range, but it's building up. This quarter revenues don't reflect it because we had some phasing of what our wholesalers bought in the last quarter, and switching into the longer term contracts which started at the tail end of this past quarter. So that's why you don't see the impact of that 13% or so within the quarter. I don't know if that was clear, but
Yeah, sure. Thank you. I was expecting that this quarter would have reflected more like 7-8% share, which IQVIA shows, or you were saying that you already had 13% share, but it was under the transition. That's why it's not properly reflected.
It's really under the transition from a inventory standpoint from the wholesalers versus our customers, longer term customers.
Thank you, Vinita.
Thank you. Next question is from Harith Ahmed.
Yeah, good evening. Thanks for the opportunity. My first question is on Solosec. We've recently had an approval for an additional indication there, which is trichomoniasis. So does this materially change the revenue profile of the product? How should we think of the opportunity here? And on the commercialization plans for this additional indication, would we be incurring incremental SG&A for this?
Yeah. So we were very pleased to get the indication approved. However, have been very tight in terms of controls on our spend. From a marketing standpoint, within those controls, the team did a stellar job of putting together a full new campaign that they launched around the trick indication. So it was just launched week before last. It was a successful launch, and we are hoping that we see an uptick from this launch over the next couple of weeks. Certainly in the rest of August and September, we are very keenly looking forward to the uptick in scripts from Solosec, and believe that this is really the material inflection that will determine how much we continue to invest in the product.
Got it. My second question is on the respiratory pipeline. On Foster, we've announced approval in UK. Just wondering, what are the plans for the rest of Europe? Do we have a launch timeline for the remaining geographies in Europe? And on generic Dulera, we filed last year. So any timelines you could share around this product and the patent situation or with respect to the brand?
So on Foster, very, very pleased to get that approval, and we're gearing up to launch it. It's actually being manufactured at Coral Springs as we speak, to launch the product hopefully later this month. And then the rest of Europe, we have plans in place and partners in place to launch in Germany, France, Italy, and Spain. That'll happen in the next fiscal year. So this fiscal year, we intend to maximize really the UK market. The rest of Europe is going to be next fiscal year. On Dulera, we have a CRL pending from the agency, but really strong communication going on with the agency in terms of our filing and what additional information they need, data they need from us. We expect to respond to that CRL later this fiscal year. I mean, our priority was really we had filed one strength first and the high strength later. So our priority was first to file the high strength and then prosecute both together. So we intend to respond to the CRL later this fiscal year. There is no patent on the product, so there is no IP hurdle on the product.
All right, got it. That's all from my side. Thank you very much.
Thank you. Next question is from Nitin Agarwal.
Hi, thanks for taking my question. Vinita, on the biosimilars business, what are the thoughts now for our PEG filing? I presume FDA inspection would be required now, since there is any visibility on that, and then where do we go beyond PEG now?
Yeah, so very excited with the PEG filing and the FDA accepting the file. We do believe the inspection will be required, but just based on what Nilesh said, the FDA started doing inspections through the local office in India. We hope that they can get to Pune to inspect our site sooner rather than later. And depending on the timeline of the FDA inspection, we hope that we are in a position to launch pegfilgrastim in the US next year. Beyond pegfilgrastim, prefilled syringe, we are also working on the on-body product. So that is making good progress in terms of development. File it in the next fiscal year, just based on the current timelines. But again, that would be an attractive product on the biosimilars front. And beyond the two, we have ranibizumab that is progressing in a phase 3 study. I mean, it's slowed down a little bit because of COVID in terms of recruitment, but still progressing. The other we have other programs like denosumab and which come in later. Eylea, which follows ranibizumab on the ophthalmic front that we are working upon. Beyond pegfilgrastim and ranibizumab.
Thanks. And where does the carving out of this piece lie? I mean, how does that?
Yeah. So
and raise money.
Sorry, can you repeat your question, Nathan? I didn't catch it fully.
I'm saying the initial comments around carving out biosimilars piece along with specialty and NC. I mean, the thought process is what you'll carve out all of these three pieces into a separate business, or there'll be three separate pieces on which get carved out. What is the broad thought process around these carve-outs?
Yeah, so our thought was really areas that need longer-term investments, and a burn on our P&L right now, but that we believe can deliver a lot of value to the organization. Biosimilars in particular, we feel, is going to be a big part of the future of the generic business. So, from our perspective, an essential investment. But when we look at our R&D spend, we look at these three areas, and granted that, specialty is not an R&D spend, it's more a commercial spend, but investment in areas that, our peers don't have for the most part, So really trying to find more creative ways to be able to, bring in additional partners, financing partners, to be able to mitigate the risk of mitigate the spend and burn on the company P&L overall, but still have the ability to grow these areas effectively, make the right investments from a portfolio standpoint, is the reason why we were looking at all three areas. And that's not to say that we will, necessarily go after, do each, but we are exploring each to see what is the best way to maximize value for the company by mitigating the P&L burden.
Got it. And lastly on that, is there a timeline by... Sorry.
No, I just said we're still thinking through all of that. It's not as if, the plans are finalized or anything of the kind.
Got it. Okay, sure. I mean, I was just asking them if there any timeline to it, but I presume you're still thinking through.
I think the one that we've made most progress on so far is the oncology, Lupin Oncology, that we have created in the US with our pipeline assets, with the idea of really trying to attract, and bring in the right investors that can help build that pipeline, for a bigger inflection close to IND filing that I explained earlier today. So that's the place where we made the most progress in terms of working towards carving it out.
Got it. Thanks and best of luck.
Thank you.
Thank you. Next question is from Tushar Manudhane.
Yeah, thanks for the opportunity. Just a clarity on this failure to supply. Is it to do with the issues at the manufacturing operations level or to do with some compliance aspect?
So it's primarily to do with COVID-related supply disruptions that we had last year.
Okay. And in the annual, so it seems to get normalized in this quarter, in the coming quarter itself, or you think this will get extended?
No, we cleared all of the supply penalties this past quarter.
Got it. And in the annual report, it's mentioned about there's some 11 US litigation settlement in FY21. So all this is to do with the product-specific litigations, right?
No, it's got nothing to do with products. Are you talking about the supply penalties, the FTS?
No, I think it's just talking about P4 litigations, Vinita.
Correct.
Yeah, those are P4 litigations.
Yeah, it's just product para 4 litigations.
So any further clarity on when the commercial traction can be expected from this?
So it varies, Tushar, product by product, depending on, our team does a very good job of trying to determine what to settle based on our position in a particular product and what to prosecute from a P4 standpoint to try to open the market as soon as possible. So each product is a different case.
Okay. I mean to ask if anything specifically in FY23 or it would be beyond FY23?
No. So we are constantly filing new paragraph 4s as well, right? Like last quarter, we filed 3 products, out of which we were first to file on 1. I mean, I think that all 3 of them are paragraph 4s. So we have a pipeline of products where we have paragraph 4 litigation ongoing that we continue to prosecute. And we settle ones that, make sense for us to settle based on our position and our likelihood to succeed in a particular litigation. And then, as we file new products, we have new paragraph 4s. So new litigation, right?
Good. And just lastly on Spiriva, so we are on track in terms of ANDA review. Any update there?
Yeah, so we are in the process of putting everything together for a CRL response in September. So on track for that and hoping that, based on that response, we will get an expedited review. But feel good about the fact that we can launch the product next fiscal year.
And similarly on the litigation side as well, is the previous quarter it was mentioned that it would be more or less starting in September, the litigation as well. So is the timeline?
We're tracking well on that front as well.
Got you. Thank you. Thank you very much.
Thank you. Next question is from Kunal Randeria.
Good evening and thanks for giving me the opportunity. Vinita, you said that you aspire to go to around 200 million a quarter from third quarter of this year in the US. But are you factoring in some competition, let's say in levothyroxine or fosterinol?
Sorry, what was the second one that you had mentioned?
Levothyroxine, fosterinol, lanthanum.
Lanthanum. Yeah, so we've already seen the impact of competition on levothyroxine, not as much on lanthanum, but definitely on levothyroxine. Based on where we are with albuterol, where we are with Brovana, where we are with the pricing pressure around famotidine, levothyroxine, Glumetza, the additional business that we've been able to take on the inline products, we feel good about growing our business quarter after quarter from this $172 million base here in Q1.
Sure. No, so okay. So more specifically, so you even if let's say competition does come in, more competition does come into these two products, you can still touch $200 million.
Yeah, I don't know specifically about lanthanum, but yeah, we feel like we have seen a good number of hits in the first quarter, and feel good about a ramp up in Q2 and Q3, getting to the $200 million in Q3.
Sure. My second question is on US itself, but slightly longer term. So you have 18 exclusive FTFs. So in the next 2 or 3 years, how many do we expect to launch?
We have a number of products in the next couple of years. The big ones that come to mind for next fiscal year are definitely Spiriva being one of the largest. Suprep is another major one. Lenalidomide is another one that we believe we should be able to launch next year. Of course, we were not first to file there, but still a very material product. So a few material products next fiscal year.
Sure. Just one more, if I can squeeze in. What are your thoughts on biosimilar pricing? For example, on pegfilgrastim, Innovate has been extremely aggressive and putting pressure on biosimilar players. So wondering what your thoughts are. How do you see this market evolving?
I see, long-term biosimilars, as I mentioned earlier, is really going to be the future of generics, just given the percentage of the market that is in biologics. So it'll operate very much like generics from my perspective. Their time to market is going to be key, and cost of manufacturing is going to be key. So, the companies that really are in the first wave of launches are really going to be the ones that will succeed the most. But I think just given the focus on bringing the cost down, and you're going to see a pricing pressure also on the biosimilars, just like any other generics. And one will have to continuously, bring in products pipeline that offset the price erosion in all the products, and ensure that a strong focus on cost of goods to stay long term.
Got it. Thank you very much.
Thank you. Next question is from Sameer Baisiwala.
Yeah, thank you so much, and good evening, everyone. You had also guided for EBITDA margin for fiscal 23. That's next year, if I remember correctly, was 21-22%. So any change to that?
There would be a reason. Samir, so we are now talking about the current year, but we would endeavor to get to those levels. It's still, it's still in the works. So I would keep you posted about, any developments on this as we go by.
Samir, I will just add to that, Ramesh, here, that, obviously, as you saw last year, our team worked very hard to deliver EBITDA improvement, and we're very committed to doing despite the challenges that we have had in the first quarter. As we deliver in the second half, like Ramesh said, at the 17 to 18% level, that'll give us better comfort, better confidence. But just given the initiatives that we have underway to improve both our US generic business as well as the other efforts around cost containment, we are very focused on getting to that 20% plus.
Okay, that's very comforting. The second question is, They mentioned about the spin-off, intentions, but I wonder if any of these three have any sort of scale for you to be able to spin off. That's one. And more specifically for Onco portfolio, what exactly do you have in that portfolio that you can monetize over the next 18 months?
So Samir, on the onco portfolio, in terms of scale, I mean, we have 5 pipeline programs in the portfolio, 2 a STING agonist and a PRMT5 that are undergoing IND enabling studies right now. They're very attractive targets, and we have fairly differentiated programs in those targets. So I mean, the oncology programs, the pipeline is, as we are having conversations with potential partners, it gets a lot of interest from our perspective. And, a breadth of pipeline, the 5 programs, and then the ability to bring additional programs through the capabilities that we have established in our NCE group in India has been very well received so far. So early days, until we start the journey of bringing in third parties, but the effort has started there, and at least from a portfolio standpoint, the 5 programs and the lead programs have garnered a lot of interest.
And Vinita, even if I can just add, even for the past, right? So with the MEC and the MALT, these are moving extremely well as programs. Into a lot of our focus on drug discovery has been in the oncology space, so it just seems to be the natural place to evolve for that structure.
Okay, and one final one, and that's Vinita, being a 7th or I guess 8th company to settle for Revlimid, if you do at some point in time, does it still make it an attractive market? And do you think with so many players, the pricing can still be, good enough for everyone to make money?
Yeah, just given the size of very few products that scale, right? As well as how we believe the generics will launch on a staggered basis, I think should enable a very, hopefully more rational marketplace from what at least our team is looking at, with companies entering at different times with different level of share targets, should really enable for the product to be a very strong product for all of the generic competitors.
Okay, with your permission, one final, sorry. Can you update us on your filings for complex injectables, peptides, depots, liposomals?
So maybe I can start, and Nilesh, please add. So making good progress on multiple fronts. On the depot injectables, we have our first program, Risperdal Consta, that's in the clinic right now. So we are hoping to, successfully get it through the clinic over the next year or so, and then file. We believe that we are one of few companies with the product in the clinic. So very excited about that opportunity. Paliperidone is following that one. On the liposomal products, we have making our partner, Fordos, is making good progress on Doxil with the intent of filing it later this fiscal year. Ambisome is planned next fiscal year. Both are on track despite a couple of months of delay due to COVID, but still on track for filing in terms of this fiscal year as well as next fiscal year. We're also making progress on our peptides as well as the iron colloid products out of India. Would request Nilesh to elaborate.
Thanks, Vinita. So we roughly expect about 4 filings on the injectable side this year coming out of the India stable. Exhibits for at least 2 peptide products in this fiscal. And like Vinita said, on the iron product as well, we'll take an exhibit and probably file shortly in the next fiscal. So good So I think our pipeline, we've consciously tried to stay away from the conventional products on the injectable side, focusing on the ones which do have some level of challenge. I think the depot injections are the furthest end of the challenge. There too, we have products in the clinic now, but on the regular injectables also, at least 4 filings this year, likely 6 to 8 filings next year. So it's starting to get to a nice tempo.
Great. Thank you so much.
Thank you. Next question is from Vishal Manchanda.
Thanks for the opportunity. My question pertains to the biosimilar business. So when you launch pegfilgrastim in the US next year, would that need you to invest into a sales force commercial infrastructure? And would that be upfront? So basically, will there be additional cost pressures on account of that?
Yeah, so it will require investment in a commercial team, small team that one would need to really be able to contract with the GPOs. I mean, some we already have for injectables, but we'll need to bolster it on the biosimilars front, and we will manage that very carefully to make sure that it's not quarters ahead of product launch. It's close to product launch.
Got it. And second, on overall capex that you would need to do for funding your biosimilar business over the next 3 years. So you have multiple biosimilars in clinics. So would each of these require a separate facility, and how much investment would go into that?
So we're actually pretty good on the biosimilar capex. There's a major expansion that's happened in the last year. It was still commissioning it. And I think we pretty much have world-class capacities now on biosimilars, both on the mammalian side and the microbial side. There's a little bit on the microbial side that we'll add when we commercialize products like ranibizumab. But we're pretty good on the capacity. I'm sure there'll be some incremental capex, but certainly not a separate facility for each product.
Got it. And finally, on Enbrel, any color on market share that we have been able to achieve in Europe?
It's a single digit right now and still launching into multiple countries.
Okay, so kind of high single digits or mid single digits?
It's mid single digits.
Got it. Okay, thank you.
Thank you. Next question is from Shyam Srinivasan.
Thank you for taking my question, Shyam Srinivasan from Goldman Sachs. So just the first question on the COVID portfolio, I missed the growth rate excluding COVID in India. I heard the numbers 32%, but is that right? Or India just grew 27%. So I'm just trying to understand what's the number.
Yeah, I can take that. So, really, as you know, the Indian market, the acute is where the real growth happened in the market. The Indian market grew by 39.2%, including the COVID therapies. This is the market, and 32% excluding those. For us, the market grew more on the chronic side than on the acute side. And so the chronic market grew 19.4%. We grew 22.6%. The acute market was 43.1% without the COVID therapies. We grew 45.4% on the acute side. But if you add the COVID therapies in there, the acute market grew 52.5%.
Okay. So Nilesh, just trying to understand what you have got in COVID in your portfolio. Is there anything that you're quantifying? I'm just...
So as you know, wave 2 was terrible, right? We all know that. And there was a very rampant increase of medicines which were used perhaps off-label as well. So we saw even increase, obviously budesonide was part of the treatment protocol. So we saw a significant increase in budesonide. We saw significant increase in the anti-infectives in general as well, even in vitamins, steroids. So dexamethasone, we have a nice product. So on steroids, we saw a significant increase as well.
Got it. So you're not quantifying a number, right, Nilesh? Yeah.
No, it's still smaller for us versus some of the other guys, right? So
Fair enough. Second question, just maybe this is coincidental, but looking at the mix of geographies now, India is like 42% and US is 35. Does it? Obviously there is some element of COVID which will probably go back, but just from a capital allocation perspective, how are we thinking about things? Do we need to allocate more to India? And just link back question to the 17% kind of growth you expect to grow, right? High teens, let's assume. And maybe market participants put it at 10-11% for the industry. So just curious in the drivers of the growth, either in terms of price, volume, new product introduction, if you could help us.
Sure. So right now, as you know, the US is extremely depressed in the number, right? So there's, it's been a bit of a perfect storm in Q1. You'll see that starting to repair in Q3, Q2, Q3 onwards. And you'll see the saliency of the US going back up and the saliency of India coming down correspondingly in that. I think the saliency is also reflective of the one-time NCE income. Again, when you take that out of the consideration set, the percentages change. These two are our big markets. And then, I think for the US, the focus very much has been on R&D and capacities, the pipeline to deliver for that. That focus continues. We've brought in a lot more focus in India, firstly on manufacturing, where we added facilities like Sikkim, which we've completely scaled up. But then also our pipeline, right? So I think we haven't done a great job of pipeline in India. I think we've done a fantastic job of partnering a pipeline to bring in India, but I don't think we've done a great job of building a pipeline. That is where the focus is. So that is one of the key result areas for last year. We now have more than 20 products in development. At least 4 of them will come to market this fiscal. And we should have 10, 12, kind of unique products coming from our own stable into the Indian market next year on. And I think these will be, obviously a meaningful growth driver. Doesn't change the story from still getting access to in-licensed products and the like, but there is a significant investment which is being made for, even some of the new age COVID products. But other than that, just for products that would fit into the respiratory space, into the cardiovascular space, into the diabetes space.
Got it. Last question on the rank order of margins. I think Ramesh made a comment that after the FTS, the US margins fell. So I'm just trying to understand, with the mix where it is, India being higher, would have expected higher gross margins, right? Or is my understanding incorrect there?
Yeah. So the gross margin in the US is higher, but there are some line expenses which come in below. But Ramesh, would you like to add some color?
No, so what you're saying is absolutely true. The US is generally the most profitable market from a gross margins perspective also. And you just mentioned the fact that the salience of India was higher, this only for the first quarter. And obviously that meant that the margins were compressed to that extent.
Got it. Thank you and all the best. Thank you.
Thank you. Due to time constraints, we will just take a last question. Last question is from Surya Patra.
Yeah, thanks for the opportunity. Most of the question has been answered already, but just on the kind of overall margin front and the R&D spend front. So the lowering of the margin is purely, it seems, coming from the US. Is that right? And in terms of R&D spend, it was indicated that it is likely to see a kind of some sort of moderation. We have, in terms of percentage, obviously it has moderated over last couple of year period, but in terms of absolute number, if you see, it is still higher. So going ahead, the margin concern that we are building, is it just because of the kind of pricing adjustments or in US, or it is the elevated R&D that we are thinking about, given the pipeline that we are talking about?
So it's definitely the margin pressure we saw was primarily due to the US, and R&D spend was obviously a little bit higher than the previous quarter. But as we look at ways of optimizing our US generic business and of the R&D spend. US generic R&D spend is the largest part. It's 70% of R&D spend. We are moderating R&D spend to prune out, tail-end products where the opportunities, are marginal. So we are working on, optimizing R&D spend as well, in line with US generic business P&L.
So it would be in the range of 9%, what earlier it was indicated, or it is likely to see some kind of a moderation or some sort of elevation from here generally.
Ramesh, you have the latest.
Last question. There was a lot of disturbance at my end.
So if maybe I can just start answering that. So I think the intention right now is to hold on to that R&D number as an absolute number. Obviously, as we get top line growth, if we are able to hold that number, then as a percentage of sales will still stay at that 9% level.
Sure. Okay. Thank you, sir.
Thank you. I now hand the conference over to the management for the closing comments.
Hello. Thank you, everyone. Thank you for your participation and your interest in the company. We really appreciate your questions. Look forward to seeing you in the next quarter again. In the meanwhile, look after yourself, take care in these turbulent times, and wish you all the best. Bye for now.
Bye-bye.
Thank you.
Thank you. On behalf of Lupin Limited, that concludes this conference. Thank you for joining us, and you may now exit the webinar.